Welcome to Talk Tickers, where we break down the earnings calls that matter. Today, we're diving into JM Smucker, ticker SJM. Now, on the surface, their latest quarter looked okay. Sales were steady, but the stock still took a nearly 4% hit. So what's really going on under the hood that spooked the market? Let's get into it. All right, here's the game plan. First, we'll cover the headline results and that initial market reaction. Then we're going to do a deep dive into what's driving the numbers. After that, we'll zoom out to get some much-needed investor context. And finally, we'll land on our rating and what we call the next call. So, Section 1, a mixed bag. And that really is the perfect way to describe this quarter. The top-line sales number didn't raise any alarms, but investors are smart, and they looked right past it to the underlying profit pressures. And there it is, a drop of almost 4% on the day. You know, that's the market speaking loud and clear. It tells us that investors saw something in the fine print that they really didn't like. So let's look at the numbers that caused this reaction. Okay, so here's the tale of two numbers. On one hand, you've got net sales at $2.33 billion, pretty much exactly what Wall Street expected. No drama there. But then, you look at the adjusted earnings per share, $2.10. Now, that's a slight miss, sure, but the real headline is that it's down a whopping 24% from last year. That is the red flag that the market grabbed onto. So, let's move into Section 2 and peel back the onion here. We're going to get into the weeds to understand exactly what is putting the squeeze on Smucker's profits. And this right here perfectly illustrates the tug-of-war they're in. They were able to raise prices by an impressive 11%. That's some serious pricing power. But there's always a but, right? The flip side is that people bought less. Volume and mix dropped 6%. They're getting more per jar of jam, but they're selling fewer jars. And if you want to see this problem in high definition, just look at their U.S. coffee business. I mean, sales soared 21%. You'd think they'd be popping champagne, but nope. Segment profit plummeted by 24%. Why? Sky-high green coffee costs and tariffs absolutely ate their lunch, crushing margins by more than 10 full percentage points. So how's management trying to navigate this storm? They're betting big on these 5 core platforms. And to be fair, there are some real stars here. Uncrustables grew 7% and is on track to be a billion-dollar brand this year. And Caf Bustelo? It was the standout, with sales jumping an incredible 41%. Now, what about the outlook? Management tightened up their full-year profit forecast. The new midpoint is $9 a share, which is just a little bit shy of what analysts were hoping for. So this didn't exactly soothe any of those investor nerves about profitability. But, and this is a really big but, check out the cash flow. The company is still aiming to generate almost $1 billion in free cash this year. This is absolutely critical. It's the engine that allows them to pay down the debt from that big Hostess acquisition, which is a key part of their long-term story. And this is a really fascinating strategic move. Management said they're facing about $75 million in extra costs from coffee and tariffs this winter. Instead of passing that along to consumers through another price hike, they're just going to absorb the hit. That's short-term pain for sure, but it's a smart play for long-term brand health. Plus, it sets them up for a potential tailwind next year when those tariffs are expected to reverse. Okay, let's pull the lens back in Section 3 and put all of this into a broader context. How does this single quarter really fit into the bigger picture for Smucker?
This chart kind of says it all, doesn't it? Over the past year, Smucker has underperformed, and not just the S&P 500 by a wide margin, but it's also lagging its direct peers in the consumer staples sector. Investors have been hanging in there, but you can feel that patience is starting to wear thin.
So, you might be asking, why should I stick around? Well, because the company is smack in the middle of a massive transformation. They've sold off the old, slow-moving brands. They bought Hostess to get a bigger piece of the snacking pie. They're focused on those 5 core platforms we talked about. And now the #1 priority is using all that cash to pay down debt. This quarter is just one step on a much longer journey. And this quote just perfectly sums up the disconnect, doesn't it? Management is playing the long game. They're talking about building brands for the future. But the market, right now, is laser-focused on the immediate problem, those shrinking profit margins and that slight miss on guidance. And that brings us to our final section, the next call. We're going to synthesize everything we've just discussed and give you our take on what to expect going forward. This is the key question, isn't it, for anyone holding the stock or thinking about buying it. You've got these conflicting signals, strong cash flow on one side but weak margins on the other. So what's the path forward? Let's lay out the arguments. The bull case is pretty clear. They're a cash machine paying down debt, the power brands are growing strong, and they have a clear profit tailwind coming in fiscal 27 from that tariff reversal. But the bear case is just as compelling. The margin pressure is real and it's happening now. Volumes are heading in the wrong direction, competition is fierce, and there's always the risk that consumers start buying cheaper generic brands. So, where do we land after all that? Both sides have incredibly valid points. That long-term transformation story is powerful, but the near-term headwinds are significant, and you just can't wish them away. For that reason, we are assigning a market perform rating. Right now, the risk and the potential reward feel pretty well balanced. Now for a little something we call an outrageous but plausible trade idea. Let's say you believe in the long-term story, but you're worried about the choppiness over the next few quarters. You could consider buying long-dated call options. For example, a call that expires way out in January of 2027. This gives you upside exposure to that whole margin recovery story that's set to play out, while your maximum loss is capped at whatever you paid for the option. It's a way to bet on the turnaround without having to sweat through all the near-term volatility.
And as always, this is not financial advice.